big thing that I'm curious about is this move in Bitcoin. Like, Bitcoin can really just keep going. There's really no stopping it. And what would you say to people that want to get in on Bitcoin, but they're seeing it at this level right now? Obviously, buying into rips is not ideal, but Bitcoin is also not ideal, and the way that it moves is not ideal. So, what do people
Yeah,
do that are in this position now? They want to get in on the Bitcoin train, but it's just at highs, and it's not an ideal time to get in.
yeah, that's obviously a very sensitive subject because there's this big FOMO area in this space, right, in crypto, because obviously things move very aggressively upwards and downwards. In Bitcoin specifically, when the rips start going, like you just said, they really do move, and I think like there there needs to be some sort of gauge like when you apply positioning, right? You don't want to just buy the local top and then sit through a nasty drawdown and just feel the drawdown, but at the same time you also want to be a part of the move if that move continues. So it comes down to risk management, right? Me personally, if I was following a strategy, I would try my best to get something on the table, right? Just to kind of
So,
like
like,
paint it
not
in the
not full
account.
size, just at
Not,
least
yeah,
something.
just as a placeholder in the account. Let's just say I want to allocate 20 percent to Bitcoin, right? And I see Bitcoin at 52K, but I know the signal was given at maybe 42K, right? For this is a hypothetical. Well, I'm like, I'm kind of paying up 10K for it, but maybe if I put 1% on, something like that, right? Just hypothetical. Put 1% on. Well, okay, now it's in my account. So now my eyes are on it. So if Bitcoin starts falling, I can size into it. Unless obviously either the model or the regime, etc., changes, the outlook changes on it, then you have to dump it. But you're not taking that drawdown on the way. Now, if Bitcoin rips, well, you still only have 1% on it. So you have to, that initial percentage has to be something that's like, okay, if Bitcoin goes down to literally Momo from here, okay, it's 22%. It's possible. I'm not saying it's going to happen, but that would be normal within a bullish trend if it did. You have to be comfortable drawing down 22%,
Yeah, and I guess
right?
that's a good gauge on what that 1% or that initial sizing should be. For some people that should be 1%. Some people it should be 5%. Where it's a move where you can take that drawdown, but also if it does continue to rip, you don't feel completely terrible and get FOMO and then make an even stupider decision by getting in even higher at the next local top.
Right. Yeah. So it should be something that's well balanced, right? You don't want to, and this goes not just for Bitcoin, if it's short vol or just equities, whatever you're trying to do. It's never fun to press all time high or local highs, right? It's never fun to be pressing long into them because it almost feels like into a way, into some sense, it's true. You have a lot more downside than you do upside. Like when you're riding upper vamp like this, you have the ability to pull back pretty easily. Like even just the mid vamp is rather easy, an easy pullback, something that we could see pretty rapidly, and that's only what 7%,
Yeah,
right?
that's totally
And
normal for Bitcoin. That can happen in one day.
literally one day that it can be at 7%. We're recording this on Friday. By the time you guys are watching this, it could be down 10% from where this recording is taking place. It's 100% possible. And the your outlook needs to be, look, if I'm going to trade something, say Bitcoin, and say I'm trading it within the context of a model, I have to be comfortable. And this is what we talked about last week, comfortable within that context of how that model moves. If that model has a certain volatility, or that strategy has some barrier of volatility, I have to be okay with accepting sort of like the max pain right out of the gate. Will I be done? Will I be out of the space if I take that max pain? The reason RQF is capped at a 20% Bitcoin allocation is exactly because of that volatility, right? Now, there's some people out there that are legitimate Bitcoin maxis. All they invest, all they own is Bitcoin, and they've been DCAing this entire move down. There's no trends for them. It's just a chart. It's just price, and they buy the same amount every month. Doesn't matter if it's up, down, they just keep piling in. And for them, it doesn't really matter. This whole conversation is irrelevant to them. So like if you're obviously going to point fingers and say like, oh, you could have just been buying at 17K DCAing and now you're up, like you don't ever need to pretty much worry about selling the odds of this going down to 17K anytime soon, or pretty low, right? So there's no reason for you to even think about selling, even if the model were to flip, right? Like, let's just say the Bitcoin model flips, okay? Those individuals will say, well, I have a cost basis of 22K. Why would I ever sell? That's the issue. That's the difference between us and them. The model's tactical. So if the model says it's time to get out of Bitcoin, it's time to get out of Bitcoin for us. That's just us. You do you, manage your own risk, hold on to Bitcoin, become a lifer, a maxi, whatever you want to do. But for us, we manage it. So we expect the framework of the RQF to guide us in terms of how this is going to work. If we're going to buy Bitcoin up here, we expect the volatility of what that historically has shown and allocate that accordingly. So you should do the same. You should allocate accordingly, not a fixed. If the percentage needs to be your comfortable area, you can't be putting money in here that, for example, if you want to buy a house in 6 months, it's probably not the best idea to put all of that money into Bitcoin today, hoping that you're going to ape it to 100K and then cash out and be able to, buy a house 2 times the size because you hit Bitcoin from 50 to 100K. That's probably not a smart decision.
But
right?
If any of you listening out there are planning on doing that and do go through with it, please let us know, because that would be an awesome story to follow.
Yeah, that would be insane. But yeah, so long story short, you want to be tactical with your deployment of capital, especially if you're late to the game, right? And that's just something you should always keep in mind with whatever you do. So let's move though back into equities, right? ES, a nice bounce this week after the poor CPI numbers, which we'll get into the inflation numbers in a few minutes. But initial hard sell off on CPI. Friday was PPI, market closed down, but still up off the lows of the week quite a bit. So that's a good sign. ES was able to hold mid-vamp here. And again, another good sign. Now, this is something that I've been pretty vocal about on Twitter, and it's real simple. A lot of perma bears are pissed this market isn't going down. They're pissed. They're fuming. Every day I got to see another perma bear in shambles. It's ridiculous, right? And the reason that they're pissed is because they're isolating data points that they want to be the macro drivers at the moment, and that's the problem. The market will take in the information as a whole, not just one piece of the pie. It won't just focus on one thing. It will digest everything. Yet perma bears and even perma bulls, both sides, like to isolate a certain sector of data and say, this is the reason why the market needs to go down. And it's all nonsense. So in terms of price structure in the market, let's keep it very simple. If this market's going to head lower and not print a new all-time high next week, one thing needs to happen. We need to take out mid-vamp. We have failed the last 2 attempts here. We have failed to take out mid-vamp. When you take out mid-vamp, you open the door for lower vamp. When you get down to lower vamp and you kind of press through it and firm up the idea that it's not going to hold, you open the door to Momo. It's a very simple process. 1 to 2, 2 to 3. And then when you're at 3 and you're pretty much at number 2, it goes 3 through 2, 2 through 1, 1 back to upper vamp, and then upper vamp to new all-time highs. That's how this works, right? And you can see that kind of here, right? When you're under Momo, it goes mid vamp 1, Momo 2, upper vamp 3, and then you have to reverse the process on the way down. So it's pretty simple. So if you want this market lower, ES has to get below and hold, get in and hold below 5,000 and start rolling over. Unless that happens, you have this price action where we can chop sideways, grind up, and most likely print new all-time highs in S&P. And the same thing goes for the Nasdaq. The Nasdaq's a little bit weaker than the S&P, though. It's holding on to mid-vamp a little bit more tightly here, obviously. Here, the break below failed. We squeezed back up, new all-time highs. the break below failed here. We squeeze up. We weren't able to get new all-time highs this week. PPI kind of sent us lower, but we're still holding up above or around mid-vamp. So this is going to be a key area for both the NASDAQ and the S&P 500. You lose mid-vamp. Again, it's super simple. Lower vamp. Lose lower vamp, go to Momo. It's really not that complicated. You should keep it this simple because that will prevent emotion, confusion, and a lot of other nonsense you don't want to be dealing with. But since I just spoke about PPI, let's actually talk about inflation.
Well, so
Now,
I just want to say one thing. So what we did see from these CPI numbers coming out and equities having that initial sell-off, but then pretty much coming right back, I see that as it's more confirmation that the market is not worried about an inflation resurgence. That's how I see it.
that's a good point, and I think to a degree you're right. So, not to a degree, you're right. The market isn't that concerned about inflation at the moment, and I think that inflation risks are always there. Look at the market like this. There's positive and negative growth and inflation risks at all times. They're just about where they're leaning. They exist. There's no scenario where there's absolutely 0% chance of inflation risk going up or down. Same with growth. You have to understand that these are dynamic values that move throughout the market cycle. So there's no just fixed number. Oh, look, we're risk-free from inflation. No worries in the world. Inflation can reaccelerate, and then it can become a problem. But it's not a problem at the moment. And there's a lot of people, when I say a lot, there's a lot of brainwashing in the macro pilled arena on X right now across all facets of inflation. Everything from the super core facet to the core PPI, all this core terminology, it's all nonsense. Okay. Core never mattered and never will because it's a lagging factor. The market's going to look beyond that. Now, you might say, well, core measures the most important basket of inflation. Yes and no, because it excludes the food and energy factors, right? Which are even more important. To take those out of the equation, it's almost like you want to take out the factors that are just as important as the other factors and isolate it to a very steady inflation gauge that is steady for one reason. It's because it's lagging. In 2008, headline CPI crashed, core didn't. You look at core, you wouldn't think there was a recession, right? So like it's such a lagging, it's a useless indicator. But
It's
people want to
almost like
harp.
these bears are trying to just find any excuse to validate what they're thinking, even if it's
They,
wrong, even if it's delayed.
they're literally having an MMA match and they're looking for a corner in a circle room. That's what's going on. They're scrambling, and it happens with bulls on the way down, just like how it happens with bears on the way up. It's a symmetrical thing, and you have to be willing to look past a lot of the noise. It's very simple. We track an inflation gauge. If that inflation gauge is bullish or is bearish, we have our inflationary pressure direction, if it's going to increase or decrease. And then we have a strength gauge that's attached to it. We follow that signal. Very simple. You can claim PPI, CPI, you can claim, services, super core, which is the most obscene measurement of inflation. That if you talk about super core on the X timeline, if I see super core, I automatically think you're a super simp. There's no way. There's literally no way you're a financial professional focusing on super core.
It's like
Nonsense. You make
trying
no money.
looking at like the most delayed possible thing you can just to validate what you're thinking.
Yeah, like come on. And it's nonsense. So let's focus on what matters. And you know what? We're talking about inflation, right? Oh, the super core was so bad. Inflation accelerating. Bonds are 10% off the lows. 10%. Bonds. I'm not talking about yields. I'm talking about bond prices are 10% off the lows. If inflation was so bad and reaccelerating, don't you think the bond market would already be much lower? Why are
Yeah,
bonds not close? Listen, I'm not saying the bonds need to be at all-time lows or 52-week lows, excuse me, but they gotta be close, right? Like we're 10% up off the lows.
yeah.
So
If there's that uncertainty that we had back then we would be nearing the lows. But right now, the bond market and even equities seem very certain about the trajectory of inflation, and that's why they're acting the way they're acting.
Right. And this is
It's
where
uncertainty that really causes problems.
the macro pills step in. They like to make their stamp, right? They're like, the market's so certain that inflation isn't going to be an issue. So I want to make the contra bet that inflation will be the issue because I can see there's a spread of alpha to be had there, right? That's how realistically alpha is taking the contrarian bet. Like our system picks up changes in the market before the market prices them in completely. And that lag, right? That lag of realization is where the alpha is generated. These bears, or these macro pilled individuals, they're not always bearish, but they typically are. They look at it like, okay, the market's discounting inflation. I'm gonna account it higher. I'm gonna reaccount it and basically try and play the market for that inflationary regime push and get ahead of it and make my money in commodities and if it's inflation, whatever they're trading, right? If it's the SOFR curve, however they're trading it. So that's an issue that I think needs some attention because just look at it. Look, the market, the bonds are 10% off the lows. Are bonds going to go right back down to the lows? I don't think so. There's not enough inflation risk at the moment to send bonds lower. And as you can see, we apparently, I'm gonna take a step back here, right, from the microphone. Apparently, we just had the hottest CPI print and PPI print in a very long time based on what's going on X, right? You read anything on these macro pilled individuals. Very different landscape now on inflation. Yet bonds came down on the CPI print on Thursday and couldn't make new lows on the PPI print today. So how bad is it? Think about it for a second. How bad is it? It doesn't seem that bad, right? Just look at the price. The narratives are bullshit. Look at the price. It's not that terrible. And let's just take a look at inflation swaps. So these are the 5-year inflation swaps. Yes, they bid up. Yes, they're up a little bit. But I mean, let's look at where they've come from. You know, we're talking about they're up 20 basis points off the lows, but they're still down off the 2023 October highs by a decent amount, by at least another 20 basis points. They got another 20 basis points to go to get to the October highs. So like, this is just price action here. Inflation has that pinning effect at the moment, which is what we've been saying for months. The amount of times I must have said on this podcast that it's going to be very easy to get inflation from 9 to 5, but very hard to get it from 5 to 2 is uncountable. Literally, there's got to be at least 10 podcasts, 15 podcasts I've said that. And it's true. Inflation is going to basically chop in this range. And that's where the risks for stage 4 emerge, right? Because the Fed is afraid. Everyone's afraid of this inflation reacceleration. The Fed sees the CPI numbers. Don't you think they're a little concerned too? They're like, oh no, and it's super core is accelerating. I mean, it's their own. The Fed has their own tools to track the super core. They literally have a tool at the Fed to track that. So they're watching this stuff. And they're seeing it, and they're like, oh, God, inflation's accelerating. We might have to hold longer. And this whole idea of holding rates longer, higher for longer, is where the problem emerges. Because by the time they start cutting rates, the delay of their rate cut policies will be too long to basically salvage the soft landing. And that's why stage 3 and stage 4 are very important. I've said this many times as well, is there a possibility we never get stage 4? Yes, there is. We can skip stage 4 and complete a soft landing. The Fed needs to have already and should already be bringing rates down. People are going to say, that's crazy. Inflation's already moving up. Yeah, you think beyond outside the box. There's lags to this stuff. This is not, I bring rates down today and inflation moves up tomorrow type of ordeal. Or I keep rates up. Or they're even talking about raising interest rates. How are you raising interest? How could you possibly fathom raising interest rates from here? If we look at the implied Fed policy, right? It ticked down this week because of this move up in inflation swaps, right, across the curve. But we're still at 169 basis points. It's the highest we've been. This is higher than 2018. Inflation's at 3.1%. The Fed's at 5.25. Hike more. What Kool-Aid are you drinking? What's the point? Why should the Fed hike more?
Yeah, there's literally no reason except to support their bear thesis.
What's funny is, hear me out. Inflation came in. This CPI report came in above estimates. The estimate was 2.9%. It came in at 3.1, 20 basis points high. And you're going to say, oh, that wasn't core. That wasn't month over month. Garbage. All nonsense. Headline CPI is what we focus on. Came up 20 basis points, right? Over estimates. It came in 30 basis points under the prior print. So it's lower than the prior print. I mean, we can take this. We could look at this like this, right? Look at this. Inflation. Okay. This is a hot CPI print right here, bros. Like, look at this. This is hot. Accelerating. Doesn't make any sense. It's nonsense.
No, it doesn't.
Nonsense. You're being fooled. Now, oh my God, now if inflation all of a sudden does start heating up under the surface, does start building up, they're going to say, we told you so. They've been telling you inflation was going to accelerate for the last, since the same people that are telling you inflation is accelerating now were the same people telling you that the Fed needs to go up to 10%. They need to raise the Fed funds rate to 10%.
Yeah, they're busting out the Truflation screenshots.
Yeah, back then. Now they're like, now they've forgot about the Truflation screenshots. They're talking about something else.
Yeah, because the Truflation is lower than CPI now. So now it's irrelevant. Now it doesn't matter.
Yeah, it's all a bunch of bullshit. Stop focusing on it, okay? Pay attention to what really matters. Headline CPI does most of the work. It's the most material. Now, so for example, you might say, well, headline CPI was great. Why did the market go down on Tuesday? Because on Tuesday, the market did care about core CPI. I'm not saying, when I say it's completely irrelevant, you have to understand the context. It was not irrelevant on Tuesday. By Wednesday, it was irrelevant, and by Thursday, it was completely irrelevant. Do you understand? One day macro event risk off the table the next day. That's not material enough for me to build a whole investment thesis and systematic model around. Doesn't make any sense. One day, garbage, waste of time. Remember when inflation was beating to the upside in 2022? Literally to the upside, and the market was tanking?
Mm-hmm.
Right? Because we were coming in above consensus?
Yeah.
That makes sense on headline. The headline was blowing out too. Okay, that's a problem.
And those were real moves, not just one-day moves.
Those were real moves because you had the Fed involved, you had inflation involved, you had the whole the macro process driving in a certain direction. But what happened on Tuesday was pretty simple. And then the reason why we bounced, again, core relevance, so that's already become support. If the reason, in fact, was the market going down on core, that was already irrelevant. That was an easy fade. The next problem that we had was volatility exploded. And when I say exploded, if we take a look at the VIX, I literally mean explode. Volatility went from, it closed on one day at 1394 and hit a high of 1794 on Tuesday. So it went up almost over 4 points, right? On the VIX.
And so
in one day.
Why did that happen, and what does that mean?
So what I think happened was we've had this very controlled environment in the market. You can see here where this type of 2% move at the lows, what we haven't seen that in a while. Like this move was 1.63%, but it was rather controlled. It was a rapid move. And I think people got scared. And what they did was they thought that this CPI print was the pivot point, time to hedge up. And they immediately chased hedges. And you can see stuff like, if we take a look at the tail decks, right? The tail decks exploded. And when I say exploded, if we take this off to make it cleaner, you can see like this type of move in the tail decks is like reminiscent of this type of similar price action at the highs was SVB level. Banking crisis stuff for a CPI print. 20 basis points over headline.
Odd. That's why I feel like there's something underlying.
I think what happened was so my theory is this. My theory is everyone raced to hedge up. They hedged up quickly, aggressively. Right? Remember, also the market's at all-time highs. So whenever a market's at all-time highs, like I said earlier in this podcast, the thought is there's almost more downside than there is upside potential, right? Like we're at new highs. What are we going to make a new all-time high, or are we going to go back down to the 52-week lows, right? So like it's almost seen like there's more downside. So it's very quick to pick up hedges, or for the market to pick up hedges, and that's what we saw happen with with spot vol, and front month vol kind of blew up too. But lo and behold, it blew up so aggressively that I think you built up enough hedgers in the process. So basically, you put enough hedges on the boat to where it was done so rapidly that there was not much fear of having to hedge further. And this process of selling and hedging and selling and hedging slowed down. And then you have a glut of hedges sitting on pretty much sitting like making a floor in the market, right? You have everyone all hedged up. So now the next 1% move is not so nerve wracking. And the 50 basis point move bounce. So going down 1% is not so nerve wracking, but the 50 basis point bounce. Now everyone's like, oh man, did I fuck up? Did I get it? Did I hedge up too quickly? And sure enough, we reversed this Tuesday move within a day. We pretty much reverse the entire move in pretty much a day. Because everyone's all hedged up. The market's not going to want to really break down when everyone's holding hedges. And that's really what we saw happen here. And that's something that I think almost put a floor in the market when we saw that rapid spike. I mean, take a look at SVIX, right? We saw SVIX flush out, rapid flush. It's down 12% on the day at one point. And I think that's something that you see when people are rushing to hedge, and it almost, again, puts a floor in. And now if there was a real material risk, like if a nuke went off, okay, something crazy, right? Like the market would have kept selling and it would have rolled and compounded and the hedging would have gone and VIX would be in the high 30s. But remember the context. I think the market got all shook up over something that really doesn't matter in the grand scheme of things. And this even goes back to liquidity conditions, right? Liquidity conditions based on our liquidity conditions index is in positive territory and didn't go into negative territory with that move. So liquidity conditions were ample. You had liquidity conditions propping up the markets. You had hedgers basically piling in so early that there was less driving there was less fear in the market. A lot of that fear got hedged out quickly, and it allowed the market to reverse. And then we even look at the credit spreads, right? Credit spreads meaning the credit conditions in the sentiment in the credit conditions of the credit default swap market, right? They're still right now they are above the bull market average, meaning they're trading at a premium to where they have in prior periods when the S&P 500 was printing new all-time highs. That means there's people that are still pessimistic about the high yield credit market today compared to where they were in, say, 2021, 2018, 2020 before COVID, when the markets were printing all-time highs. That tells you that there's still some pent-up bear demand in the credit markets that likely needs to get burned out before we see a real top in this market. And that doesn't mean that the high yield credit spread, the spread here needs to go to the green line and then the top is in, it's confirmed. As you can see, it can trade under for quite some time, but it's just a gauge saying like there's probably a little juice here left in the tank in the credit markets that could prop up the markets a bit here. So to get fully bearish is, if the model starts signaling that, we will 100% follow. Listen, the rules are the rules. They're there for a reason. If you don't have them, you have nothing at all, right? So if we don't follow, if the rules do trigger, we have to follow them. But I think we're not going to really see a major adjustment to the underlying outputs of the model, because there's these underlying factors like this, for example, that are just supportive for the equity markets. The liquidity conditions, just again, another supportive thing. And we look at things, risk assets like Bitcoin up so much. We look at equity markets holding mid-vamp. These are all bullish stuff. Like, find me the bearish stuff, I'll believe it. But we're just not seeing it yet. We're just not there yet. And I think as things progress, obviously things will change every day. That's the best part about having a data approach, a systematic approach. We can look at this every day, come in when we look at our reports with a clean slate, and the report makes the story. Whatever that report says, however the outputs of the system plus the market structure as we're seeing here, whatever they start showing or signaling, we take, it gets put in, we see it, and we just feel the way it feels. But that's it for this week, guys. If you have any questions, feel free to reach out to us on Twitter at The Market Radar, or go to our Discord. The link can be found on our website at market-radar.com.